about the basis of technical analysis. Now, that's a big word and it scares a lot of people. So let's start off beginning by saying that technical analysis is really, it's an entire huge field. Most people think it's just this field of indicators and oscillators. That's one little section. So I don't use the word technical analysis in my everyday words and working because I call this chart analysis. Because everything and anything you do on a chart is technical analysis. So technical analysis is the study of price movement on a financial chart. We can think of technical analysis as a sort of framework that traders use to study and make use of price movements of a market. Technical analysis focuses exclusively on the study of price charts and trading history to determine future price movements. Now, granted, we're going to talk about a lot of mathematical formulas, but every formula out there, every indicator, every oscillator is based on only a couple pieces of input. You have the open, the high, the low, the close, and volume. That's it. Now, there's all types of mathematical and statistical algorithms they add to that, but it's all based on the open, the high, the low, and the close. So as I said, I call technical analysis chart analysis. Technical analysis, anything you do on a price chart, just looking at a line chart is really technical analysis. Now, the primary reason that traders use technical analysis is to make predictions about future price movement based on past price movement. Technical analysts believe that all current market variables are reflected via the price movement or price action. And this is what we call price action. We don't really call it price movement. It's the action of price, how price is moving on the chart. And the only thing that controls the entire market is price action. Because no matter what your indicators say, no matter what your oscillators say, no matter what your support and resistance are, no matter what your moving average tells you, the only thing that has any control is the actual price. So if we believe that all market variables are reflected via price movement, it only goes to reason that we don't really need much else to analyze and trade the markets besides price. Now, I am a technical analyst. This is what I trade by. I put very little time in fundamental analysis. But it's important that you don't ignore fundamental analysis. Now, fundamental analysis is things like economic events, news, political events, elections, headlines. So they do have a huge effect on the markets. And by not realizing that the jobs report is due out, at 2 o'clock today, or the central bank is going to raise rates at 2 o'clock today, all of your analysis could be completely right, your technical analysis, but because that little event on that calendar at that time is going to cause market volatility, maybe you need to move your stop loss a little farther out, or maybe you want to make the trade a little bit later. So fundamental analysis is important. Then we talk about stocks. What's going to control a stock? But earnings reports, return on investment. That's fundamental analysis. Now, technical analysts look for patterns on charts that tend to repeat themselves. They do this to develop their trading edge. The underlying logic here is that since most price movement is driven by human beings, certain patterns will repeat themselves in the market as human beings tend to be repetitive in their emotion and their market interaction. So let's break this down to something simple that we can understand. Okay, if we look at a price chart, the chart you're looking at is a chart for the pound Canadian dollar. Now, here we're not looking at any indicators or oscillators. We're not looking at any mathematical formulas. We are looking at a pattern that developed on the chart. Okay, this is what we call a triangle. But this is an area of technical analysis. It's called chart patterns. And whenever we've seen a triangle develop on a chart, which happens quite often, we can then use that to make smart trading decisions. Okay? Because we know as price moves into the apex of this triangle, sooner or later going to break out. Now, we don't know if it's going to break out up or down, but the minute it breaks out, we could trade the momentum of that breakout. And that breakout momentum is usually the distance of the width of the triangle. Okay. Now, there's a lot more to learn then, but that's one of the fields of technical analysis. Another part is support and resistance. Support and resistance zones are the steps up above price and how it's moved historically. Now imagine you're running up the steps at some theater and you're jumping up 2 steps at a time. Somebody else is walking 1 steps at a time. So you can go look at how the last time the theater was sold out and how long it took the people to move up and down the steps and how many people went 2 steps and 1 step. And then you can use that to determine when that theater is sold out the next time and it's 5 minutes to 8. What happened last time at 5 minutes to 8 when the theater was sold out? How did the people move? So we call this support and resistance. And these support and resistance lines you can draw on your charts by going back and looking at a chart historically to see where it price hemmed and hawed in the past. Now, here we go. This is the euro US dollar. This is my teaching chart. But look, when we look back here, what price was significant? That price was very, very significant. So we dropped on a line of chart and projected it into the future. We would expect the next time the euro US dollar was trading at this range, we could expect something to happen. We saw it happen here. We saw it happen here. We saw it fall below and come up to the high here. We saw this support line here. And look at this. Every time price fell all the way down, it came down to the support line, bounced back over, came back down below, bounced back over. So that's helped us interpret the markets. Okay. And this is also in the field of technical analysis. Now, before I go on much farther, I forgot to mention, if you look on your screen, there's a little place that says handouts. I've put 2 handouts in there for you. There's nothing you have to register for, and there's nothing you have to put in. There's nothing you have to pay for. Just click the little download button. One of them is the Introduction to Technical Analysis from investing.com. This is an incredibly great resource guide. You can just download it and keep it, use it whenever you want, and it will break down the entire field of technical analysis and give you examples of chart patterns to indicators to oscillators. I've also given you the Technical Indicators Guide handout. Here we evaluate some of the leading technical indicators and how they work. So click on the download buttons and download them now because they are only available in the live class. So we've already seen that technical analysis isn't about these indicators and oscillators. They aren't about complex mathematical formulas. Technical analysis also encompasses learning to analyze the market structure, to find trends, support and resistance levels, and generally learn to read the ebbs and flows of a market. There's obviously discretion involved here. And I will be the first one to tell you that technical analysis is more of an art than a science. Because like when we looked at those support and resistance lines, those were done by me eyeballing. Okay, they are based on my decision. No, there's no formula for that. I went back and historically looked at price and came with these levels and put them on my charts moving forward. And next year, when the euro is back at this range again, those lines will still hold. But this is what makes you a better trader than the guy next to you. Okay. But then there's a lot of things that are formulated. Moving averages. Okay. Trend lines have very specific rules. But before you do all this, you have to learn to use charts. So most traders instantly think of a price chart like the one above when someone mentions the word technical analysis. Price charts provide us with an amazing amount of useful data that paints a complete picture of the market's historical and current supply and demand situation, as well as the price levels that the market participants have deemed to be important. Price analysis or price charts are also a reflection of all market participants in belief about the markets and the market variables. So by focusing your analysis and trading on the market's price chart, you can streamline your trading and at the same time analyze the results of everything that contributed to the price movement of a market. Now, you've heard the old adage, history tends to repeat itself. So technical analysis is a method of predicting price movement and future market trends by studying charts. Now, there are 5 categories in technical analysis theory. So we have reading price charts, whether they're bar charts or candlesticks, understanding trends and trend lines, interpreting price patterns, which we looked at. There's triangles. Well, here, let me take you back and show you the list of chart patterns. Hold on a second, because I've got a little chart I made up for you. This is what we call market structure. And as you see, there's all different types of patterns that appear in the price movement. We have double bottoms, triple bottoms, double tops. We have bull flags, bull pennants, descending wedges, bear flags, bear pennants, inverted head and shoulders, expanding wedge, cup and handle, and regular head and shoulders. Well, most of them I don't pay much attention to, okay, because I don't even see them in our price of trading. I don't even see them happening. They do happen, but you don't notice them. But triangles, which include wedges, pennants, bear, anything that forms a triangle on my screen, tells me something important. But this is called market structure or market patterns. And these patterns happen often, and they have very specific rules about them when they happen. Like you can measure the width of the triangle to judge and set your target price. You can use the swing low before the breakout to set your stop loss. You can wait for the third bar outside of you wait for the first bar to break out, the second bar to confirm, and trade at the third bar at the height of the breakout. These are all standardized trading decisions that work extremely well in the markets. And they're all part of what? That's it, technical analysis or chart analysis. So then we have indicators and oscillators. And then we can break this down into the more oblique, or you can call them indicators, but they're number theory. There's Fibonacci retracement tools and Fibonacci numbers. There's Gann numbers. There's waves and cycles. But most of us don't go over to those things, but they're quite dependable, but they take some time to learn. But indicators and oscillators like MACD, RSI, stochastics are very, very popular. Moving averages falls into an indicator. Okay. And then, of course, we have volume. So reading a price chart is really a pictorial price history. If the objective is to predict the future price, then it makes sense to focus on price movement. Price movement usually precedes fundamental developments. By focusing on price action, technicians are automatically focusing on the future. So technical analysis can assist you with entry points and exit points, stop loss points, and take profit points, because you won't be able to get any of this from fundamental analysis. Just because Google earnings report was much higher than expected, much better, and their growth was better than expected. Well, we could expect Google's prices to go up. But how are you going to know if Google hadn't already gone up pre-market, or at what point you want to exit, or at what point do you want to consider entering the market, or does the move up still have the momentum? You're only going to get this by looking at a price chart. So we have line charts, bar charts, and candlestick charts. And these charts are visual representations of price. Because if I were to say to you that the euro is trading at 102.74, it was trading at 102.75 an hour ago when it opened at 103.47, and it closed last night at 103.76, and about 15 minutes ago it jumped all the way to a high of 104.7, then fell to a low of 102.42. Can you repeat that? Can you tell me what it actually did? No, but if I put those same numbers on a chart, guess what? This is where that old saying, a picture's worth 1,000 words. This is where it comes true, because you can see price movement on price charts, where our brain can't take in all of these numbers. But when we put them in a visual format, our brain can take in all that data. Now we have bar charts, line charts, and candlestick charts. But again, the most they can make good use of is the open, the high, the low, and the close. So a bar chart is simply a bar placed at the open of a time frame and the close of a time frame. But in our market, the buzzword is candlesticks. Now, when I started trading 45 years ago, we all used bar charts because we were charting by hand and sitting there with graph paper, and drawing the open, the high, the low, and the close on a chart is a lot easier than drawing a candlestick. But once you do this, you can see specific prices that are important in that price movement. So candlestick charts were invented in the 18th century by rice traders in Japan. They came to the US, not into the Western world, not until the 20th century, and they've become a lot more popular with online trading and the development of HTML and Java charts that allow us to use them and change the settings very easily. Now, a lot of the things that we think about that fall into technical analysis come from Dow theory, from Charles Dow, okay, who was the first person to think of using other than fundamental analysis to evaluate the markets. Now, candlestick charts are the most popular of all major charts, and as such, they are the type that you will see often as you trade, and they are also the type I recommend you use when you learn and trade with price action strategies. But now that you can read your price chart, you need to put it to work. Now, learning to read a price chart isn't difficult, but takes a little bit of time. Okay, let's go over to the chart again. Let's go back to my euro US dollar. Now, what we're looking at is, this is my standard teaching charts, the euro US dollar, which is the asset we're looking at. It's a 30-minute chart. Now, today, we're not going to learn about time frames. That's part of our charting class. And you have to learn to use these charts. You have to learn to use all the tools and how to use time frames and how to put things on your charts. Okay, because you can't just read a chart. But what we're looking at is a candlestick chart. Now, today, because everything is so easy for us with computers, we can jump back and forth. Now, this is a bar chart. These bars represent the exact same price movement as the candle, because the price is the price is the price. Nobody can change it. It's just how it's visually represented to you. Now, unfortunately, too many people see red and green on charts, and they see too much red, and they want to say, oh, the price is going down, I need to sell. They see too much green, they think price is going up, they want to buy. Well, that's not really what candlesticks are about. Candlesticks are more about the patterns of the different candles and the body and the wicks of the candles. See, this is called a body. Now, here's a huge body, but here we have a tiny little body. Here we have an average body. Then these things above and below are called wicks, and they cover the high, the low, the open, and the close, just like a bar chart does. Because, like I said, none of this changes if we change it to a bar chart. It's just a visual representation that we see. Now, we also have a line chart, which is the most simple of it all, and we really can't use it for much of anything because it just uses the close and puts one dot on the chart. And as you can see, we can't really see anything about how price is moving. We see a general representation of the overall move, but we don't see what the high was. We don't see what the low was. We don't see what the open. We see only what the close was. But candlesticks are the most well known. Now we have indicators that are added onto or over top of price, like a moving average that I just dropped on your chart. That's the gold line up there. And that is a standard interpretation tool, but it falls in the area of indicators. Then we have down below here what's known as MACD. MACD is an indicator, a momentum indicator that's dropped on the bottom of our charts. Now it's used as the open, the high, the low, and the close, but other formulas, and it's placed below price chart. We also have indicators like Bollinger Bands, and let me get rid of some of these here. Like Bollinger Bands, which is a trading band which is dropped on top of price. And then we also have indicators like RSI and stochastics, which are added below. And these are called bounded oscillators. So there's a whole family of indicators and oscillators. Then, of course, we have trend lines. Trend lines are lines drawn on charts that help us interpret price movement. And trend lines are a rule-based line. They indicate the trend or the movement of a chart, of a price. We also have, because then it helps us interpret an uptrend. When price is moving in an uptrend, it makes higher highs and higher lows, higher highs, higher lows, higher highs, higher lows, and higher highs. Okay. And this is how we can interpret a market that is trending. Now, the way I like to explain this is price movement is random. Period. End. It's random. It's a bunch of human beings doing things all over the world that cause some type of movement. It's random. But there are certain times that price moves in non-random fashions. And that's when we're making uptrends and downtrends. And when we have an established uptrend and downtrend and prices moving in a non-random fashion, we can then apply some good, hard analytics to determine where we should enter the market and where we should exit the market, and to trade from that move. Because the old adage is the trend is your friend. You never want to be a counter trend trader. People like to say, price is high, I'm going to sell it now because it didn't go well. But that doesn't tell you anything, because price can continue going higher, higher, and higher. And statistically, if you stop to think that to push a price up steadily in a non-random fashion takes a lot of energy from a lot of buyers all over the world, that once that momentum is started pushing that price, you're better off trading with that price because everybody's pushing it in your favor. And statistically, you might do well trading against a trend, but statistically, you will make more pips trading with the trend than you will against the trend. And the ultimate goal is to make the most pips you can and to minimize your risk. So picking the peak to sell against where it's going to fall is what we call catching a falling knife. But trading this trend line and waiting for price to come back down to that trend line, because we know it's going to continue upward, that we can then trade, enter at a lowest price possible to trade in the direction of that momentum. Now, support and resistance, I had shown you drawing these lines on there, but simple chart analysis can help identify support and resistance levels. These are usually marked by periods of congestion, where the price moves within a confined range for an extended period. Now, there are many ways to find the support and resistance. My use is called eyeballing. There's also something called pivot points, which are numeric calculations. We also have Fibonacci levels, which are a Fibonacci retracement tool, which will do this by giving us percentages of the prior move. And then lastly, we have chart patterns, which we've looked at: triangles, wedges, symmetrical triangles, expanding triangles. Okay. And all of these patterns exist in charts. Some will show us reversals, some will show us continuation. But as I said, all of these patterns have formulas that work, that have been tested over and over and over, that help you judge the momentum of a breakout, that helps you set your entry point and your exit point. To trade these chart patterns, simply place an order beyond the neckline and in the direction of the new trend. Then go for a target that's almost the same as the height of the formation. And then from there, like I said, all of us want to go to technical indicators. Okay. But remember, indicators only indicate. Indicators are the interpreters of market. If you're looking at price action and your support and resistance and your trend lines on your chart, and you really can't understand what they're trying to tell you, an indicator can work as a interpreter, and they can help you interpret what price is trying to tell you. They should never be your primary decision maker, and they should always be your secondary line of decisions. And so why use indicators? Indicators serve three broad functions: to alert, to confirm, and to predict. An indicator can act as an alert to study price action a little bit more closely. Technical indicators can be used to confirm other technical analysis tools. If there is a breakout on the price chart, like breaking out of a triangle, a corresponding moving average crossover could serve to confirm that breakout. According to some investors and traders, indicators can be used to predict the direction of future prices. A technical indicator offers a different perspective from which to analyze the price action. Some, such as moving averages, are derived from simple formulas, and the mechanics are relatively easy to understand. Others, such as stochastics, have complex formulas and require more study to fully understand and appreciate. But remember, indicators indicate. Even though it may be obvious when indicators generate buy and sell signals, the signal should be taken in context with other trading technical analysis tools. An indicator may flash a buy signal, but if the chart pattern shows a descending triangle with a series of declining peaks, it's probably a false signal. Many traders swear by use indicators to help them timing their trades or to alert them of trends. But even for an investor more focused on the underlying fundamentals of a company, learning how these indicators work can provide added conviction on new or existing trades. So we have momentum indicators, we have volatility indicators, we have volume indicators, okay, and they all tell us something about the markets. Oscillators are the most reliable in periods when there is no clear trend in the market. Prices are moving sideways in a narrow range between a particular support and resistance level. As such, an oscillator might tell you when price is finally going to start taking on an upward or downward move from that sideways action. However, problems come when the market moves in a certain direction, support and resistance is breached, and a new trend emerges. That's why it is better, in case the price breaches a support or resistance and a new trend emerges, to ignore the oscillators completely. Technical analysis considers the market to be, or technical analysts consider the market to be 80% psychological and 20% logical. Fundamental analysts consider the market to be 20% psychological and 80% logical. Psychological or logical may be open for debate, but there is no questioning the current price of a security. After all, it is available for all to see, and nobody doubts its legitimacy. The price set by the market reflects the sum knowledge of all the participants, and we are not dealing with lightweights here. These participants have considered everything under the sun and settled on a price to buy or sell. There are the forces of supply and demand at work. By examining these price actions to determine which force is prevailing, technical analysts focus directly on the bottom line. What is the price? Where has it been? And where is it going? So even though there are some universal principles and rules that can be applied, it must be remember that technical analysis is more of an art than a science. So remember, technical analysis will tell you what the price is, where it's been, and where it might be going. So thank you very much for joining us today. Thank you for supporting Alvexo. And if you go to www.alvexo.com and go to their Trading Academy, you can learn all about the indicators and oscillators and learn how to use them. Or if you want to see a recorded version of this class, go to www.investing.com or use the link you used to come to today's class in about 24 hours. So thank you very much for joining us, and we'll talk to you again real soon. Have a great day now. Bye.